Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Alrighty, good morning and welcome to the U.S. Market Update. I'm Emaad Akhtar. The Dow Jones Industrial Average had a slip up on Wednesday after private sector hiring hit its lowest level in more than 2 years, raising concerns that trade policy uncertainty could be weighing on the U.S. economy. The 30-stock Dow lost 0.2%, ending at 42,428. The blue chip average snapped a 4-day winning run. The S&P 500 advanced 0.01%, pretty marginal, and closed at 5,971, while the Nasdaq Composite rose 0.3% and settled at 19,460. A report from payrolls processing firm ADP showed that payrolls increased only 37,000 for the month, less than the downwardly revised 60,000 in April, and below the consensus forecast of 110,000 that economists polled by Dow Jones were expecting. Well, for more insights, we are joined by Kyle Rodda, Senior Financial Market Analyst at Capital.com. Kyle, good evening. I believe you're in London. It's pretty late over there.
Yeah, it's late over here. It's great to be with you.
Yeah, thanks for coming on, Kyle. Let's start off with some currency talk, shall we? The US dollar has been in focus of late, recently pulled back from a 6-week low. In fact, some Wall Street banks are reinforcing their calls that the dollar will weaken further, hit by interest rate cuts, slowing economic growth, and President Donald Trump's trade and tax policies. For example, we have Morgan Stanley saying the greenback will tumble to levels last seen during the COVID-19 pandemic by the middle of next year. JP Morgan Chase remains pretty bearish on the U.S. currency. What do you make of these big bank projections of the dollar? Should they be taken seriously at this point?
I mean, certainly, yeah. I mean, if you, I think, look at either Morgan Stanley or Bank of America's forecast for the Euro-USD, that was sort of talking about 125 by next year as well. So they're fairly significant moves. And I guess, we're really speculating here, at least from a cyclical point of view, the end of US exceptionalism, which of course was such a strong narrative at the start of the year, and the reason why we saw such strength in US assets, but as well as the US dollar too. Effectively, Trump's trade policy has ended that trade, if you will. We're seeing already in the data that the US economy is converging with the rest of the world, which is, relatively sluggish. And then, on top of that too, there's stories outside of the United States, in particular Japan, which of course are, dealing with still above target inflation, and, speculation that interest rates will need to be hiked further there as well. And then in Europe, there's, been a really strong impulse, I suppose, coming from the fiscal side of things for the euro, really because around sort of German remilitarization and that kind of fiscal spending that's likely to come through in the short to medium term. So, really, it's quite fundamentally justified that we're starting to see this kind of cyclical downturn in the US dollar. Of course, when everyone gets very, very bearish, you start to speculate whether maybe we are due a bit of a bounce. But from a cyclical point of view, again, it seems quite justified that we continue to see a weaker dollar from here.
Yeah, in the real world scenarios right now, do you see global investors actively rotating out of dollar-denominated assets, or is it still more narrative than movement?
No, I think it's, quite a substantial story. And I mean, if you look at the dollar story, I think, there is the cyclical element that we just outlined then, but there's also the secular element too, which is, more or less that de-dollarization theme, which has sort of two broad drivers of it. One is, perhaps for some, a kind of paradoxical weakness coming from the US dollar because of US trade policy. Of course, if you looked at just sort of trade theory in and of itself, typically it would say that, obviously a smaller trade deficit would lead to a stronger US dollar. But what we are seeing, in fact, is a much more sort of capital flow driven sort of dynamic emerging, which, the fact that we're seeing potentially these sort of surplus countries moving their FX reserves away from US dollar assets has actually weakened the US dollar. So there's one side of the secular story there, effectively, surplus countries not parking their reserves in dollar assets. The other element too, of course, is that, the US has proven itself to be somewhat of an unreliable boyfriend, to borrow a term once Mark Carney, I believe, by a UK politician. Yeah. And that is, effectively to say that what the US has done over the last few months is really shake faith in its institutions and its governance, and therefore investors are diversifying away from, treasuries. So again, there's very much legitimacy in that story, and I think it's more than just narrative, it has to be said.
Yeah, Kyle, a recent Reuters poll of FX strategists found that most emerging market currencies will hold the gains they've made this year or extend them against a retreating dollar in the next 6 months. The EM carry trade has long attracted investors chasing returns. Do you see that gaining momentum against the backdrop of what's happening right now?
I think a lot of it's going to depend on how trade develops from here because, I mean, this is somewhat of the ironic thing for emerging markets here, provided that, we do see yields, continue to behave reasonably well and we don't start to see the big sell-off that we saw in April and obviously towards May, which was probably a little bit more driven by, perhaps Japanese bond markets, is that provided that the yields stay stable and that, basically servicing costs for debt remain relatively stable, the weaker US dollar might actually be quite beneficial for emerging markets, more broadly speaking, and actually loosen financial conditions. Again, if we get that kind of Goldilocks scenario. The big variable at that point in time becomes trade policy because, of course, if we start to see trade deals not materialising or negotiations breaking down and tariffs increasing again, especially on China, then that's going to weaken the global growth story. And then you start to talk about that flowing through into weakness towards in emerging market economies, and also just quite naturally risk aversion, broadly speaking, that's going to tighten financial conditions too. So, provided again that we sort of see trade policy remaining fairly stable, improving from here, and that, obviously global bond markets continue to behave in a reasonably stable fashion, then, of course, the weaker dollar in and of itself should be a bit of a boon to emerging market economies and emerging market currencies.
Yeah, fair play. Let's shift gears a bit and talk about big tech stocks, which seem to be powering market gains again. You suggested that the recent tech results are being underappreciated. Why do you think that is? Well,
in short, it's because the Magnificent Seven delivered 27-28% earnings growth last quarter against expectations of 16%. And if you do look at the performance over the last sort of 3 or 4 weeks of Wall Street, it's been largely driven by those sort of mega cap tech names just come off the basis of these earnings results. And I think maybe and quite justifiably the commentators like myself and media more broadly have been very much gripped by the trade narrative because it's been the most pressing. And of course we wouldn't have seen the market recover the way that we have over the last, call it, 6 weeks if we didn't see the Liberation Day tariffs sort of unwound or negotiations being entered into by the United States. It doesn't diminish that at all. But, if you do look at where the strength is coming through on Wall Street, and again, the lack of breadth on Wall Street as well, both when it comes to equity market performance as well as earnings growth, it's really these Magnificent Seven stocks that are shooting the lights out with earnings. They're continuing to exceed estimates when it comes to, earnings expectations. Not only that, earnings guidance as well. And to sort of sweeten the whole deal, they're simultaneously saying that they want to spend more money on artificial intelligence, so the capex there, which they've proven that they're starting to monetize, but they're also returning capital to shareholders through buybacks and other sort of capital return policies, dividends and what have you too. So they're just sort of ticking off every single box at the moment. And I think, we start sort of alluding to before narrative maybe not being necessarily matching reality sometimes. I think this might be an instance of that where we're so caught up about the risks, the trade wars, quite justifiably, that we're missing some of those good news stories, which is, big tech, that the Magnificent Seven, ex-Tesla probably, are absolutely shooting the lights out and giving investors reason to buy those stocks.
Yeah, I guess it remains to be seen whether this renewed appetite for big tech is sustainable or whether we're at risk of over-concentration again. I suppose time will tell. Final question, do you think strong tech earnings signal a broader economic rebound, or are these companies simply insulated from macro headwinds?
I think it's a secular story related to artificial intelligence. Of course, if we see disruptions coming through from trade policy, which could affect these companies through, obviously, tighter margins, maybe it sort of starts to slow the investment cycle a little bit. And there's these perpetual risks that, obviously the US and China trade war turns into something a little hotter than that somewhere down the line. All of those things could disrupt that secular story. But for now, and again, you sort of compare the earnings performance of these companies compared to, say, the S&P 493, which only delivered, I say only, earnings growth of sort of 8 or 9% compared to that 27% from the Magnificent Seven names, is that they're monetizing artificial intelligence investments now. They're still putting money in as the capex to continue to grow those future earnings as well. And even despite some of this kind of bearishness and weaker economic conditions prevailing in the United States, they're delivering those results. So, this is a big tech story. It's at the moment they're sort of fairly resistant to the economic cycle, and it's the thing that's notwithstanding concentration risk, which is a big problem. basically propping up S&P 500 and obviously the NASDAQ as well.
Yeah, we've got non-farm payrolls coming out on Friday, so that'll give us a good indicator of the health of the U.S. economy moving forward, at least for the foreseeable future. Kyle, it's been a pleasure having you on the show as always, and you can get some good rest now.
Thank you so much for having me.
Cheers, Kyle. Have a good one. That was Kyle Rodda, Senior Financial Market Analyst at Capital.com. You're listening to Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.